Here's another uncomfortable reality. Paper silver is massively oversold. Futures markets, ETFs, and derivatives have created a price that does not fully reflect physical scarcity. This works until it doesn't. When confidence cracks and physical demand spikes, paper claims don't protect you. In the US, retail investors often assume liquidity equals safety, but liquidity disappears exactly when you need it most. Physical silver, held through volatility, has no counterparty risk, and that matters far more than short-term price swings. But let's go deeper, because this is where most analysis stops and where real insight begins. Silver is historically undervalued relative to gold. The gold-to-silver ratio remains far above long-term norms. Every time that ratio reverts, silver doesn't politely rise, it outperforms aggressively. In past cycles, silver has doubled or tripled while gold merely climbed. Selling silver early because it feels up ignores how asymmetric this setup really is. Now pause for a second and ask yourself this. Why is mainstream financial media suddenly comfortable talking about silver again? Why now? Historically, broad attention appears not at the top, but during the early to middle phase of a larger move. The real mania comes later, when prices are far higher and supply is gone. That's when people who sold early are forced back in at much worse prices, or locked out entirely. Here's the part few Americans like to hear. The U.S. financial system is transitioning from abundance to constraint. Cheap energy is gone. Cheap labor is gone. Cheap money is gone. That changes everything. Assets that rely on trust suffer. Assets rooted in physical reality gain power. Silver lives in the real world. It doesn't care about narratives. It responds to stress, scarcity, and necessity. And don't ignore geopolitics. The U.S. is reshoring manufacturing. That sounds patriotic, but it's expensive. Domestic production requires massive infrastructure, energy investment, and raw materials. Silver sits at the center of all of it. Meanwhile, global fragmentation is increasing. Supply chains are no longer optimized for cost, they're optimized for security. That increases demand buffers. Buffers consume inventory. Inventory shortages drive price. Here's the psychological trap. Silver moves slowly, then violently. Most people sell during the slow phase because it feels boring or uncertain. They assume opportunity cost. They assume I'll buy back later. But silver's biggest moves don't give you time to think. They happen fast during crises when access is limited and premiums explode. By the time confirmation arrives, the price is already gone. In the U.S. especially, retirement systems are dangerously exposed. Pensions, 401ks, and bond-heavy portfolios rely on stability that no longer exists. Even a mild loss of confidence forces capital to seek alternatives. Gold gets the headlines, silver gets the velocity. That's how it has always worked. So when someone tells you to sell silver because it's already up, understand what they're really saying. They're thinking in months, not in cycles. They're reacting to price, not to structure. They're trading noise, not positioning for disruption. Silver is not a get-rich-quick asset. It's a get-out-of-system-early asset, and those are never comfortable to hold right before they matter most. The real danger isn't volatility. The real danger is being underexposed when confidence breaks, and confidence, once lost, never returns slowly. If history is even remotely a guide, the people who regret selling silver won't regret it quietly. They'll regret it loudly. When price no longer matters, availability does. And by then, it will be too late. Everyone is telling you the same thing right now. Silver is up, profits look good, and this might be the perfect moment to sell. Headlines are flashing, YouTubers are screaming take profits, and social media is filled with charts pointing straight down. But here's the uncomfortable truth almost nobody wants to say out loud. Selling silver right now could be one of the biggest financial mistakes you make this decade, especially if you live in the United States. And the reason has almost nothing to do with hype and everything to do with what's quietly breaking under the surface of the American financial system. Silver is not just another commodity. It's not just a shiny metal people trade for fun. Silver sits at the intersection of money, industry, energy, and national security. And right now, all four of those pillars are under extreme pressure in the US. When those systems crack, silver doesn't just move, it explodes. The problem is that most people sell before the explosion, not after. And history proves this again and again. Look at what's happening in the U.S. economy right now. Debt is at record levels. Interest payments alone are becoming unmanageable. The government is borrowing just to pay interest on previous borrowing. That's not a theory, that's math. And when debt reaches this stage, there are only three outcomes: default, austerity, or inflation. The U.S. will never choose default. Austerity on a meaningful level is politically impossible. That leaves inflation, persistent structural inflation, the kind that doesn't go away just because the Fed raises rates for a few months. Now here's where silver becomes dangerous to underestimate. Unlike gold, silver is both a monetary metal and an industrial necessity. You can't electrify the economy without silver. You can't build solar panels, electric vehicles, advanced weapons systems, or modern electronics without it. And the US is pushing aggressively into electrification, green energy, AI infrastructure, and military expansion all at the same time. That means one thing: industrial demand for silver is not cyclical anymore, it's structural. But here's the twist most people miss. While demand is rising, supply is quietly breaking. Silver mining is not growing fast enough. New discoveries are rare. Costs are rising. Many silver mines are actually byproducts of other metals, which means supply doesn't respond quickly to higher prices. Even worse, above-ground inventories are shrinking. For years, the market relied on stockpiles to cover deficits. Those stockpiles are being drained. Once they're gone, price doesn't move gradually, it gaps violently. And this is where U.S. investors are especially vulnerable. The American financial culture trains people to trade, not to hold. Take profits, rotate assets, chase yield. That mindset works in stable systems. It fails in transition periods. Silver performs its most powerful moves during moments of monetary stress, not economic growth. And the U.S. is entering exactly that kind of phase, whether Wall Street admits it or not. Think about the dollar for a moment. The U.S. dollar isn't collapsing overnight, but it is losing purchasing power every single year. That's not accidental, that's policy. Inflation is a hidden tax. It reduces the real value of debt. And when a government is buried under debt, inflation becomes a feature, not a bug. Silver historically thrives in that environment, but not in a straight line. It moves in brutal waves designed to shake people out before the real move begins.